Welcome, everybody. Welcome. All right. Hello, everybody. Welcome in. Welcome in. All right. Hey, welcome to another capital gains tax deferred sales trust mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated assets, defer a lot of tax, get some diversification, get some liquidity, get some peace of mind, get some entrepreneurial freedom, have an opportunity to create and preserve more wealth, harvest your gain, have optimal timing. There's so much that the Deferred Sales Trust offers, and this is why we're here every single Friday to bring to you the secrets of the Deferred Sales Trust, make it very simple and make it very digestible so that you can overcome any false beliefs that you have about the Deferred Sales Trust, about if it works, is it legal, will it work for me, is my deal big enough, what can I do with the investments of the funds? We're literally in it every single day. And part of what we want to bring to you are the kind of the culmination of the week of what we've gathered in solving problems. Because at the end of the day, we're in the business of solving problems. And I want you to look at this Rubik's Cube. This is our ongoing analogy, right? Everyone shows up with a little bit different scenario to solve. And our goal is just to work with you and your professional advisors to figure out a way to solve this. And as we turn, if everyone's seen the new movie, I think it's what's her name, the Queen's Gambit, right? And it's the Queen's Gambit. That's a chess one, right? There's another one that they do these competitions, and these guys solve it in like 6 seconds. Now we can't solve your Rubik's Cube in 6 seconds, but what we do like to do analysis with you to try to get the congruency of whatever you're trying to solve, with the tax being the biggest thing that is the impediment for a lot of our millionaire clients that holds up deals from happening, or just dissipates wealth, somewhere between 25 to 50% of the gain. And so that being said, I'm joined by one of my business partners, financial advisor extraordinaire. He's somewhere in Colombia today, I believe. Jake Miller, how are we doing?
I'm doing very well. Yeah, it's wonderful to be here, Brett. And the wonderful part of what we do is we can help people from all over the world, or we can be anywhere in the world and still help people. So happy to be here today, all the way from Colombia. You can see from my background, it's tropical, it's wonderful, it's great weather. And even with all that being said, we're having some fantastic conversations with a lot of people every single day about the Deferred Sales Trust. Individuals still that have crypto, even where the price is at right now, individuals with real estate, individuals with business sales, stock options, warrants, all kinds of fun and exciting things. And it's just a great time to be alive, Brett.
It is a great time to be alive. And by the way, for those joining now I'm officially live on YouTube. We had a little glitch on that. And so I'm going to say a quick little intro one more time. Sorry for those who are already on the Zoom. My name is Brett Swarts, and I'm founder of Capital Gains Tax Solutions. And we're just here to help you make the Deferred Sales Trust simple, to see if it can be a great fit for you, unlock the secrets of all of the inner workings of the deals that we're seeing every day, and then help you achieve this for yourself or for your clients. And so Jake Muller, one of my business partners, one of the financial advisors extraordinaires, and he is with me. And so we're gonna go through kind of like the kind of couple of live deals that we're working on right now, and then we're going to open it up for questions. But the overall vision, Jake, is to solve the problem, Jake. And so for the Deferred Sales Trust, just so we can clarify as people are starting to watch this, who is this for? Like, and who would qualify? Is there kind of a minimum, and kind of give us like who this works for, Jake?
Absolutely, Brett. Anyone with a highly appreciated asset, $1 million or more, $1 million of net gain. And what is a highly appreciated asset? I get that question all the time. A lot of times we say highly appreciated assets, and they think it has to be business owned. It can be business owned, but it doesn't have to be. You can also have things that are personally owned, even including your own personal residence. Now, of course, why do we say $1 million? We say $1 million because we want the tax paying to be sufficient enough that it warrants the need and the necessity of having a financial advisor, having a trustee, and going through the entire process with the tax attorneys to make sure that it makes sense for everybody involved, and that at the end of the day, you you can have this ongoing commitment to be working with us so that we can help you utilize the Deferred Sales Trust in the most tax efficient way in future reinvestment objectives.
Exactly. Fantastic. And by the way, it works for stock, it works for business sales, it works for cryptocurrency, it works for primary home sales, it works for investment real estate, it works for GP interest, LP interest, carried interest, captive insurance, it works for artwork, collectibles, NFTs, really just about anything that's highly appreciated. And in fact, we believe the Deferred Sales Trust was created for just a time like this, where we've had some major swings in the marketplace, and especially with cryptocurrency recently taking a huge drop. And we actually have a special guest today. His name is Mark Yegi. And Mark, if I think you are prepared. I know we didn't chat until your last of my podcast, but I do see you're here. So are you prepared to be interviewed a little bit and get some feedback on what you're seeing in the marketplace?
Sure. Didn't know that, but all right, bring it on one of these crazy days in the market. Sure.
Yeah, and so I'm excited to bring Mark Yegi on. And Mark, for everyone who's here today, it'd be great for you to give a little about your story and your focus, and then we can kind of dive into just your experience with helping people create and preserve more wealth, and then just taking a look at the overall sense of crypto, real estate, financial stocks, those kind of things. So, Mark, where are you from, and give us a little bit about your background.
Well, I'm a Floridian that travels around the world, kind of what Jake was saying a few minutes ago. I run 3 hedge funds. One's a crypto hedge fund, one is a hedge fund for income and growth, and the other one is a aggressive hedge fund, which today is not doing too good. But if you're not in the stock market today, just be happy and thankful. But there are other days that are good. So anyway, what I do is I help people make what I call safe, reliable income of 1% to 2% a week, 2% to 4% a month. And I do it by playing defense in the stock market and offense. So we take an asset in the stock market. And I had no idea you were going to be asking me this question, but I'm glad you did. You take an asset in the stock market, and we find a gambler out there that's willing to pay us income on it. And the income that we get is basically a promise to the gambler. It's an option. We promise the gambler that we'll sell him our stock at a predetermined price before a predetermined date, and we create 1% to 2% income conservatively on that. On a weekly basis, or if you like to go a little more conservative than that, it's about 2% to 4% a month. And so you can end up playing a lot of defense, especially right now, where you're getting income and the stock is continuing to decline. So, for example, most of us are in Tesla. A lot of people in my mastermind group are in Tesla. Tesla's down 48% from the high 6 months ago on November 22nd, I think. And most of our people are down just a little bit, or maybe they're up because they've been creating income all the way down. So they're certainly not down 48% if they've done this right. So I don't know if that's what you wanted me to.
No, it is exactly right.
Yeah.
I mean, really, it's just the timing of this and the value of the Deferred Sales Trust. So Jake Miller, and bring Jake back in. So the value of the Deferred Sales Trust, Jake, when you have these wild market swings, highs and lows, stocks, crypto, real estate, what's a good question and thought on what Mark just said there to be able to hedge and protect and play some defense?
Absolutely. So how often do you think that we'll be possibly trading in defense as well as, being aggressive in this type of model? How often monthly do you think that we might be in and out?
So, for example, I'm rarely out. So even in a market like today, I'm handling the swings because every week I get to create that income from the gambler that pays us. So we sell calls against our position. So we own a piece of Tesla, a share of Tesla, or 100 shares of Tesla. And people come in, and right now, because the volatility is so high, they're willing to pay us a ton of money on a weekly basis, is what most of us are doing to create income and play a little bit of defense. Does that answer your question, Jake?
It does. Now, would you compare this to options trading as an income engine for a portfolio?
Yeah, it's a covered call strategy. It's modified. It has a system of rules built around it to prevent you from making emotional decisions, because emotions are the enemy of the trader. So yes, it's an option strategy, more specifically covered calls and spreads.
Now, Mark, I want you to comment on my next comment, which is directed towards Brett. So Brett, okay. With this strategy, I'm going to compare it to multifamily with doors. I'm going to compare it to multifamily with doors because, in the sense, you're getting income from the doors, like you're getting income from options trading, or you're getting income from this strategy. At the same time, you're hoping for an appreciation of the overall profit. Am I in line here with what I'm comparing?
Yeah, with one small exception, we as long as the stock doesn't go out of business, we don't care if it goes up, down, or sideways. We prefer it to go sideways to slightly up because on a day like today, where Tesla's down 10%, you feel it in the short term on your options. But you don't look at Zillow every day if you own the apartment complex. You're just collecting the rent every single month, and so it's very similar in that fashion. Just not so much on the capital appreciation. We don't get the upside.
I love this. See, you know what they say? Get into the room with people that are smarter than you, and then you just get smarter. So this is why we have Jake here and Mark here as well. And Mark, so now I want to bring this together a little bit with tax, right? Because it's capital gains tax deferral. So you mentioned a couple things, right? You make money when it's sideways, up or down, these different things, and it's that emotion of even the short term, right? I want to connect this with the cryptocurrency market, with Bitcoin being at a high at about 69,000 just a few months ago, down to about 25,000. Right? And that emotion of, oh no, I don't want to exit at a high because of the tax. So talk to us about that and your personal experience and with your clients when people are like, the capital gains tax, I'm just going to hold because I don't want to pay it.
Yeah, so there's two sides to that capital gains story, and very few people ask me this question, but the IRS hasn't quite figured out the cryptocurrency taxation thing. They ask you a declaration question. Did you buy or sell cryptocurrency last year? And you better say yes, because there's no reason to hide it. But they also don't have wash sales. So if you guys are familiar with the wash sales, you can't buy and sell something within 30 days at a loss and expect the loss to go against your capital gains. So last year, since you asked me about what I did personally, I basically, when crypto went down, I sold it and bought it right back. Now, here I am, hopefully, declaring it on a Zoom call, but I did it completely within the law because there is no wash sale on property. There's wash sale in the stock market, and it's not treated like a stock. So I was able to take a capital loss, a short-term capital loss, because I did it within a year of buying it, and just lock that loss right in. I could do that again because it's also gone down. On the other side, if you're somebody that bought it at 10,000 and it went up to 60 and you didn't sell, that's fine. You didn't have to pay the gain on something that ended up backtracking in profit. Does that make sense?
Yeah, it does. Go ahead, Jake.
So there's a word for that, and there's a lot of investors actually here on the call right now that have been invited, special invitation from Alphi, which is an advisory firm, and that's typically tax harvesting, but kind of a little bit more unique. Would you maybe just provide a few more details there?
Yeah, I just actually did a presentation last week to my mastermind group about tax harvesting. And that is, if you have a big loss on your account, whether it's a short-term capital loss or a long-term one, you could take it against your like-kinded gains, so long-term capital gains or short-term capital gains. And, you could just take them right off the table, and that kind of, brings your tax situation right down. Probably leads right into what you guys do. But yeah, certainly you can take advantage of that if you have a loss on the books and you intend to hold the asset. You just can't do it in the stock market on a like-kind investment. You can't. It's like a 1031 exchange, but but you could do it with options. So if you own a March 2024 option, you can roll it or sell the March 2024 and sell it and buy the June 2024, for example. It's a different security. You just can't do it if you buy Tesla, sell Tesla, and then buy it right back, because if you do that within 30 days, you don't get to take the loss against your gains.
So hopefully what you guys are catching up on, right, is that every little thing is a little bit precise and unique to your situation. And the key is to try to bring in the who, not be the how, about how to solve these things, right? And part of our niche focus is to be able to exit high and defer that capital gains tax using the deferred sales trust. So can I defer capital gains tax on Bitcoin or Ethereum or other cryptocurrency? The answer is yes. But I think even the more important question is, why use the deferred sales trust in a time like this? And what we've been hinting at here is, when the market's high, you can sell high. Or even Tesla, you said down 48% in the past 6 months or the last year, Mark. Just to give you guys the Monday morning quarterback. I think the deferred sales trust has never been more valuable in such high highs and low lows, and such quick. It's, what's the word? Precipitous, right? My wife, we had 5 kids, and you always go in there and we're like, hey, we have a history of the word's always hard to say, precipitous labors. And they're always like, yeah, sure you do. And we're like, no, we do. Like, it's in our family. And they're like, yeah, the nurses are always, and then sure enough, they send us home. We come in for our first baby. Hey, just go home, come back, tomorrow. They did the check and all that stuff. And we're like, okay. And so we go to a place, one of our favorite restaurants called Dos Coyotes, a Mexican restaurant. And we literally sit down and we get our food, and right there, and all of a sudden her water pops and bursts. And all of a sudden, it's just like chaos. And we're rushing to the hospital. And like, oh, sorry, we should have believed you. But my point of all that analogy, just to get some flavor and some comedy, hopefully in here, comic relief, but also to see that these crashes can happen fast. And if you have the ability to exit high and defer your capital gains tax, right, and then wait on the sidelines or defer stock purchases, right? You can also work with public stock or private stock, okay? And then you can defer the tax, and then you can literally, the trust can go back and buy back into those positions at a low. And so one of the deals that Jake and I did was for a client. She had 50,000 of Bitcoin, and it went to 50 million. And at 54,000 a coin, it was worth 50 million, and that was her target to exit 5 million. So she exited the 5 million and deferred all the tax. The tax was about 1.85 million. She lives in California. And so she says, I want to invest into a business venture and also invest in some securities and get some diversification. So we did that with Jake. And I called her when Bitcoin hit 60,000. I'm like, hey, I know you sold at 54,000 a coin, but your 45 million is now, I don't know, maybe 50 million there now because it went up. And I said, you kind of got your money back there a little bit. Do you want to exit another? And she's like, I'm still getting to know you guys. I don't have a clear plan with that money. I still believe in the long-term future of Bitcoin. I said, okay. Then Bitcoin went to 65,000 a coin. And I said, hey, just pinging you again. I don't want to push you, but it's at 65,000 a coin. Your 45 million is now, I don't know, at that point, maybe it was like 53, 55, maybe something like that. Fast forward, it went to 68,000, and she said no, I didn't push her, but I said, just so you know, we could exit at 68,000 a coin, 69,000 a coin, hypothetically. You're $60+ million now. Put it into the Deferred Sales Trust just in case the market does drop. And if it does, you could literally have the funds just sitting in the bank for a period of time, or securities diversified, and buy back in when it's low. And sure enough, as we know now, the cryptos or Bitcoin's dropped to 25,000. Now it's working its way back up a little bit. But that's the ability of this. So Jake, talk about optimal timing. And then Mark, I want you to comment on that as well. And just that ability to be able to do it in this market like this.
So Brett, one thing to recognize is that there's multiple different markets. Geographically within real estate, there's, let's say, the California market or the Bay Area market or what have you, right? And investors who invest in multifamily understand that there's a multifamily market, there's a residential real estate market. The same thing is true for the bond market, the stock market, the crypto market, and then within those markets, there's smaller markets. Optimal timing. When it's time to sell, when things are high, it's not always time to buy, right? So this is the most common complaint I hear about people who are trying to fit the round peg into a square hole with like a 1031. They're trying to force it to work, but they can't make the timing deadlines because it's really good to sell, but it's not really good to roll things over and buy. If they have to do that, then they have to like exit one market, leave the California market, go to the Florida market maybe. It just makes it more complicated, more difficult. The wonderful and fantastic thing of the Deferred Sales Trust is we are able to control timing. If you want to do what you know very well, and if what you know very well is real estate, you can wait 2 or 3 years, however long it takes, to get back in. In the meantime, we're going to be efficient. We're going to do what I call corporate investing, which just in the meantime, we're investing in such a way that it's incredibly liquid, not incredibly volatile, and it's available for that next big opportunity that might catch you by surprise. You might want to liquidate within a week to go buy that piece of real estate. If you are open to other forms of assets or you are wanting to diversify, well, get out of that asset that you're in right now. I mean, if the market's high and it's the right time to sell, whether it be crypto, whether it be real estate, whether it be marketable securities, whatever. Let's say it's real estate for this example. Let's sell out of the real estate. We can reinvest in marketable securities, or you can go reinvest in that business venture. You can do a joint venture, get into business with I'm not promoting you get in business with your best friend. Sometimes that ends a friendship. But like if you have a good deal out there somewhere and it's not the same thing you've been in, that's another magical thing about the Deferred Sales Trust is it allows you to get in and out of asset classes and get in and out of different types of markets so that timing is in your favor rather than against you.
So Mark, can you comment on that? And then I want you to comment exactly how you're doing that again, because you touched on a little bit about what you did, but comment on the ability to eliminate the pressure of the time because you're deferring the tax, or in some scenarios we're actually eliminating the estate tax altogether because we move it outside the taxable estate. And then connect it with how you're doing that with your put options and the calls.
Yeah. So I'll start off by saying that my crystal ball's in the shop this week. So I can't really predict whether the markets are going up or down. Obviously, I just try to collect that income. But what I understand what you guys are doing correctly is you're basically exiting a market at the top. If you're an expert in your market, let's say it's real estate, you're trying to exit at the top, preserve that capital, maybe thinking you're going to go back into real estate or something else, right? Can you go into stocks if you want?
Yeah, that's the beauty.
Yeah.
There's no like kind requirement, right? So you can sell high and buy low in different marketplaces.
Yeah, I mean that sounds incredibly flexible. So that's something I just learned. And I mean, I would say if you think real estate's a little toppy, and it probably is in some markets, you get out. And if you have some kind of vehicle like this, you go maybe into the stock market when the Fed gets tired of doing its gyrations, making the market go down, because there's going to be some value here. Some stocks are down 60, 70, 80%. Netflix is down about 50, 60%. Tesla, I just told you, 50. Facebook is down 60, 70. So there are some quote unquote bargains out there. And if you could do this without having to pay that tax, deferring that tax, and allowing now to go into that second wave of increase when things go back up, you've basically stair-stepped your gain. And if you're hopefully deferring it to another time where you don't have to pay huge taxes, then it sounds like a pretty good deal.
Yeah, it's an amazing deal. We call it's no longer about cash flow; it's about tax flow, right? And the key is that tax flow means the timing aspect. And we just did a car wash sale out of San Diego, $13 million exit, and it was 4 partners that had bought this vacant land in Chula Vista, and it used to be an old taco stand, and they built a car wash, and their basis was about $4 million. They ended up selling it for about $13 million. So they have millions of gains. And guess what? They're not in the business of buying existing buildings that are $13 million, which is the like kind, equal or greater value forced 1031 blockbuster method. They're actually business of buying land and developing. So their plan was just to sell and pay the tax, but they didn't want to do that. And they found us and they said, oh my gosh, wait, I can sell and defer the tax, and then I can still use the funds to maybe go into crypto, go into securities, and also go back into real estate. We were already going to do that anyways, right? Except now we have an extra, for California, it's an extra 40% of their gain. And so to give you guys real numbers here, what does it take to make, on a 13 million minus a 4 million times 40%? Pull up my calculator here. So you're looking at minus 4 million. And so we're at $9 million gain, about 40%. It's at $3.6 million. And so, Jake, if I was in a race and we were running a marathon, right, and we'd say we both trained for it and we're both excited, we're about the same age and same, fitness, but I gave you a 40% head start, right, to go out there and do what, to start 40%. Was it 27 and a half miles? Is that it? No. Is it what's a marathon? I'm not sure what it is. But what are the odds that you're going to beat me, right? Or that you're at least going to be able to pace yourself and not have to overstretch or take on too much more, pressure. I might get injured because I'm sprinting so hard to try to get you, right? And that's the whole idea. We want to be able to make wise decisions with our wealth, and sometimes it is defense and preservation, and sometimes it's striking when the iron's hot. But Jake, what are the odds you beat me in that race?
The odds are incredibly high. And let me paint the picture a little bit. Actually, on Tuesday, we give a presentation of just, investing, dollar cost averaging, what have you. Somebody starting in their 20s at $46 a month would end up with the same result as somebody in their 60s doing like $3,000 a month, right? So the odds are really high, Brett, unless you really put on your Greyhound shoes and all those other things that you said we were equal with, we've trained the same, all those other things, those would have to be different in order for you to even catch up.
Perfect. So now I'm going to open it up for anyone who has questions now. I know me, Mark, and Jake, we went a little longer here today because we had a special guest, Mark. But does anyone have any questions or thoughts or comments for me, Jake, or Mark? We'd happy to put it in the chat. Also happy for you to just unmute yourself and say hello, where you're from. And We do have one in the chat right now that I'll answer for Dennis in just a second here. But does anyone want to unmute yourself and say hello and ask a question or have a comment?
I have a question.
Sure.
When do you finally have to pay those taxes? At some, you're deferring. The word deferred means you got to pay them at some point. When do you have to do that?
Yep. Think of like it. You want Jake? Or want me to go?
Yeah. If you let me comment, then you can fill in the gaps.
Sure.
So we're talking about the opportune time in when we buy, when we exit, when we enter, etc. The other magical piece of this, and I keep talking about magic as if it's mysterious, right? But we try to explain it also that it becomes more of a science and people can understand this. Literally, Mark, the power of timing is in our hands, not only to buy and sell, but of when we decide to pay taxes. Typically, people have a transaction and taxes are forced on them because the transaction is recognized. What we're doing here is we're not recognizing the transaction now because it's happening at the trust level, not at the individual level. So we're able to then in the future decide when, instead of reinvesting the proceeds of some of these future sales, when we decide to take the principal personally, and only at that time it becomes, a K1 to us personally and is either income, capital gains, or however it went in, it comes out that way.
Why would you ever do that then? Why wouldn't you just defer it forever?
So proper legal language here is that we set it up on a schedule, and there's nothing wrong or against resetting that schedule every so often. We don't tell people that we have intentions of doing anything in perpetuity, but we like to advise our clients that we're setting this up so that someday we do plan on paying the IRS. We are acknowledging on all the tax returns, we are acknowledging the deferral, and that yes, this money is owed, but in the meantime, we're able to make use of those dollars by reinvesting them now, just like somebody would inside of an IRA, right? They could buy and sell Coca-Cola or what have you as many times as they want, and they don't owe taxes on the sales proceeds until those proceeds are taken out. And that's kind of what we're saying.
I think I'm picking up what you're putting down because I saw a little smirk from Brett when I asked the question. So
yeah,
I got you.
Let me give you some more context to that too. So, I mean, it's not unlike an IRA or a 401k or even a 1031 exchange. The IRS is no stranger to tax deferral. In fact, it's the basis of how they can incentivize and not force us to trade real estate, to trade crypto, to build multifamily properties and get depreciation, to do the things that they don't do very well, right? And so the incentive is to keep the funds invested into businesses, right? And that's really the key, right? The use of the funds, right? So they say, how do we get all of these funds that are held up into, let's do the example again of Bitcoin, right? Would the government have loved for, let's say, every U.S. citizen, or really anybody who has, just keep U.S. citizens, keep it simple, right? IRS tax code. For everyone who owned Bitcoin, I don't know, maybe it's $1 trillion. I'm not sure exactly what the Bitcoin market is exactly. I know crypto is about 2.5 to 3 trillion before the crash, but let's say it's $1 trillion for Bitcoin alone, okay? Would they have liked everyone to exit at that 68,000, 69,000 a coin, deferred the tax and infuse it into the stock market, infuse it into multifamily housing, infuse it into businesses that create jobs, that create income, versus something that perhaps is not necessarily creating economic, a substance for them, right? And that's kind of the thought here. Like what they're encouraged us to do is to exit when it makes sense and not hold on just because of the tax, right? So that the funds can, it's like water that gets stuck in a pond and gets stagnant. They want the money to be flowing. It's a study of macroeconomics. The more they can encourage us as the taxpayers to take funds and reinvest into the economy. That's part of why the deferred sales trust, you're wondering, well, can I buy a primary home with it? Well, you can definitely take a distribution, pay your tax on that, and do the primary. But the funds itself can't be invested into a primary, right? Because that's really, for the government, it's like that's too close. It's also why a 1031 exchange can't go into a primary. It's too close for basically personal use, which really doesn't have as much substance for them to create more jobs and more tax. And by the way, there's lots of tax being paid, right? Now they are deferring that tax on their gain. Yes, that's true. But guess what? They're getting income from the trust, right? Which they pay ordinary income tax on. I pay fees on the management fees. Jake pays tax on his management fees. And then the jobs that are created, hopefully from this, they're going to pay taxes. And so it actually is really a win for the IRS. Any thoughts there, Jake, Mark, or anybody else? You're welcome to join the conversation. Great.
I would just add that, I mean, it's an allowable strategy. It's a business trust. It's perfectly okay to do what we're doing. We do it in such a way, and financial advisor, trustee, we're here alongside of the client to make sure that they live within the guardrails of what it can and cannot do. And so from a very high level, we join the team. We become this dream team to help the client accomplish their objectives. We are very quick to tell them what they cannot do, which, it's very small, that list of things, right? In the realm of reinvesting. And we are very, very good at strategizing because we've done this so much. In fact, Brett's got, I think he has like 10,000 hours equates to a professional. He's probably a professional 3 to 4 times over. And in this realm of deferred sales trust. And so there isn't really anybody better in my mind to assist an individual going through this process and just knowing the truth of what it can and cannot do, and what they should do outside is what they can do inside of the deferred sales trust. Oftentimes, there's additional strategies that we bring to the table because not everybody's situation is the same. And the deferred sales trust maybe doesn't answer 100% of the equation. It maybe answers 75% of the equation, and we either accept the tax consequences of the other, or we bring in other tax mitigating strategies to the table.
Thank you, Jake, for that. Appreciate that compliment. So I'm gonna answer the question on the chat here for Dennis, and then anyone else who has a comment can unmute yourself or raise your hand so we can get to you. Otherwise, me, Jake, and Mark will keep talking here a little bit. So Dennis asked, I am selling my primary home and may net $900,000. Will that work? It's a great question, Dennis. If you're still here, Dennis, would you unmute yourself so we can just clarify a few things and walk you through it? Otherwise, I can kind of make a few assumptions. So are you with us, Dennis? Are you with us?
I'm here. Yes.
All right, Dennis, and you just have to say where you're calling from. Are you in California? Because that'll help. Or what state are you in?
California, Pismo Beach.
All right, Pismo Beach. Yeah, it's an amazing area, one of the most beautiful areas. And so, curious, is this something that you've owned for a long time? Did you buy it at a pretty low price? What was your purchase price?
Purchase price was 1.1 million, and I have it on the market now for 2.3. But I think it's a little bit high, so I'll probably get about 2.2.
Okay, so you're about 2.2. And how much debt do you have on the property?
1,000,001.
Okay, got it. 1,000,001. And are you married or single, Dennis?
Married.
Okay. So that means you get what's called the 121 exclusion, right? Which is, for those that are wondering, it's if you've lived somewhere 2 of the last 5 years in a primary home, the government gives one of the best tax eliminations that we rarely have, which means any gain that is $250,000 above what you bought it for. In this scenario, Dennis bought it for $1.1 million, would be tax free. So let's say he were to sell it for $1.1 million plus $250,000. If he were to sell for $1.35, it would be tax free. Now he's married, so he gets another $250,000, which means his really adjusted base is 1.6. Although there's one other question that I forgot to ask, which is this: Dennis, did you put any major capital improvements into the property?
Probably about 50,000.
Okay, so we'll add another $50,000 to that. Let's say accumulated adjusted basis, which puts it in about 1.65 million. 1.65 million. Dennis, do you understand how I got to that number?
Yes, I do. Yes.
Okay. So then we're going to take the 2.2 million. Now you're probably going to pay some commissions and some closing costs. Maybe let's just use it at 5%, just as roughly that. So that puts it at about 2.1 million, give or take. And we're going to minus that 1.65 million, which makes it a gain of $440,000. Okay, $440,000. And the great state of California is about 13.3%. And some people go, and by the way, in federal about 20%. Okay,
wow. Yeah.
So it's combined to be about 33% of that number. By the way, it's $145,000. Let me come back to that here in a minute. Some people they get this often confused. They go, "Well, my income is only this," and when I go to the tables in the IRS, it says, "Oh, I'm in the 15% bracket." Well, guess what? Dennis? because you're selling something for $2.3 million and you have this gain, it can push you up into that higher bracket. It's a common misconception. So that's why it's 20% federal and 13.3. Now, of course, check with your CPA. There might be some things there, and you might perhaps you're not making any income at all, and this could be perceived as only making 440. Although I think 440, Jake, if I'm not mistaken, would still put you in that higher bracket there. So let's just use 33% as the number. And so your taxable liability is $145,000. So if you do nothing and you sell it tomorrow for tax deferral, $145,000 state and federal. You follow that, Dennis?
Yes, I do. Yes.
So now the question becomes, is this a good deal? Is the Deferred Sales Trust worth it for you? And you did mention you had a debt of 1.1 million. So I'm going to put this 145 on the side here, and I'm going to take that about $2.1 million number, right, was the approximate exit. I'm going to minus the debt of 1.1 million. And that's going to be about $1 million or so there. And I'm going to take 145,000. I'm going to divide it by that 1 million. That's about 14.5%. 14.5%. Keep that number handy there. I do like to see, Jake and I do like to see in the tax attorneys, typically around 25%. Doesn't mean that 14.5% is not a home run for you. It's just generally speaking, on all the deals that we do, it's maybe a base hit, maybe a double, right? Given where we're at. But let me ask you a few other questions. Dennis, do you plan on using any of the funds to purchase a brand new primary home?
I'd like to use some of it, yes, to purchase another home.
How much?
Maybe 300,000.
Okay.
Just 20% down on a million, 250.
Okay, so 250. Yeah. Okay.
Yeah.
So part of remember what I said during this conversation, that part of the disadvantages of the Deferred Sales Trust is that we can't tax deferred use the funds to buy a primary home. However, we can use the Deferred Sales Trust to defer portions of this. This is the part where it's kind of the law of diminishing returns. So in order to get that 14.5% or about that $145,000 of tax deferral, you would need to put the entire amount of closing, all the net proceeds into the trust, right, which is about $1 million.
Okay.
So in this scenario, if you were to take about 250, basically that's about 25% of the million, which is basically going to be about 25% of the 145,000. And so that becomes 36,000 less. So you're starting to get into the range of 108 here, 900. So I take 108 and I minus the 250 over here. So now I'm at 750 on the net proceeds. So now I'm going to take 108 divided by 750. So now I'm still at 14.5%. So the question is, Dennis, do you want 750 minus some fees, or do you want 750 minus the 108? So 750. And then Jake's going to check on my math, by the way. 641. So you can have 641, 100, or you can have about 750 minus some fees. So I think it became a base hit. Jake, what do you think? What did I miss there?
Brett, you're pretty good. You're spot on right there.
Okay. Mark,
So
Dennis, go ahead. And Mark, I'm going to ask you for your insight here in a minute because you're kind of a new perspective on this. Go ahead, Dennis.
The 750 will go into the trust.
Yeah, so 750 minus some of the closing costs would go into the trust. Right. And so that's kind of the math versus 641. You have total freedom. Just, you don't have to worry with the trustee. You don't have to pay these ongoing fees. You don't have, so that's the part where, again, if you had $1 of tax, it'd be a no-brainer. You just pay the $1 of tax. It'd be free. Right. If you had $300,000 of tax, well, it's a no-brainer. Yeah. You do the Deferred Sales Trust. But the fact that you have $100,000 of tax, it's kind of like, So, Mark, what are your thoughts on, Mark? I'm curious on your outside perspective here looking in.
I'll keep some of the thoughts to myself about living in California, but that's different. But I do want to say kind of a more broad thing. And I love the way you just kind of went through that calculation, because there's major value in doing that. And now I see why you guys are talking about the $1 million at the top of the call. But you will never pay any more money to any entity or any person in the world than you pay to the tax person, right? To the IRS. unless you get divorced, and that's a whole different issue. But like that's your biggest creditor, right? Is the IRS. So anything you can do, it's like that 40% head start that you were talking about in the marathon, which is 26.2, by the way. And it's that head start. Like if you don't get that head start, you're now 40% behind. It's not just the head start. Look at it the other way. So it makes a lot of sense. Even in Dennis's case, it makes sense because it's, $100,000 extra, cash. Okay. He doesn't have a little bit of overhead. If he pays the tax, he doesn't have to worry about, the overhead that he pays you guys or whatever, but then he might do it. He might have something again in the future on the, the next time he, if real estate keeps appreciating. So to me, in that case, even in Dennis's case, it makes a lot of sense.
Dennis, thank you, Mark. Dennis, any thoughts on that?
Well, not really. I think I understand everything. I have another property I'm going to be selling too, to bring another 500,000. So with the same thing, can we just add those together, or?
Absolutely, Jake. You want to take that one, or do you want me to take that one? Because I talked a lot that last one.
Why don't you start the ball rolling, and I'll keep it going.
Okay. So Dennis, let's do the same thing really quick. What did you buy it for?
I bought it for $647.
Okay,
and it's worth $750 now, and I owe about $200.
And it's only worth $750, you said?
Yes.
Okay. Did you put any major improvements into it?
Maybe 5,000. That's all.
Okay, so we'll just keep that the same. How long have you owned it for? Because it hasn't been depreciated.
Yeah, we just bought it made it into an Airbnb, which didn't go too well, so we're going to sell it after 1 year, which is in August.
Okay. Got it. So $750. Okay, we're going to minus that 5% closing cost. This is a rough number. Minus the $650. We're going to assume there's really been no depreciation. That's only about a $62,000 gain. Do you own it free and clear, or about 100?
No, we owe about $197.
Okay,
so we're
about 200.
About 500,000.
Got it. So before we even go there, that $62,500 is your gain, right? So I took the 650. And I mean, you can add the 5,000, 655. We'll do exact number. 655 with the additions or the improvements, and then I'm going to take 750, and I'm going to times that by 0.95% because that's the closing cost, and that's my first number. So 712,500 minus 655,000, which gives me about $57,500 gain. And again, we're going to apply the California, but here's the little nuance. You're going to have an additional 3.8% Obamacare tax. So you have 20% federal, 13.3 California. So 33 plus 3.8. So it's about 37%. So you're looking at $21,275. So let's just call it $22,000. Okay. $22,000. So now I'm going to take that number and I'm going to go from your 5 about 500,000. Yeah, that's a good rough number for the net into there. So 500. So this is pretty skinny, right, Dennis? You see it here. It's actually only about a 4.3%. Remember how I said I like the ratio to be about 25%?
Right.
So this would not be a great deal for you. So if I'm in your shoes, and if you're I just say pay the tax. It's not big enough. Jake, anything to add to there? Did I miss anything?
No, I think you're spot on. And again, my goodness, quit doing that, will you? One of the other things, Dennis, that you might consider where this one's when I say where it's a smaller deal, there are some other tax mitigating strategies that you might want to incorporate on the smaller deals so that at the end of the day, it's more of a game of, should I pay the government taxes or should I invest in like oil and gas? Or should I participate in a mineral charitable strategy that gives me a 4 times multiple on my deduction? Or should I? So there's a number of other things that you can do that kind of put the option in your hands. They're not necessarily as good as the deferred sales trust in the sense that you get to actually continue to reinvest the gross assets minus attorney fees rather than minus taxes. But you still have the choice of where to put the money based on some of these other investments that give you deductions.
I see. Okay.
And by the way, one of those, Dennis, is investing into multifamily value-add properties where you can do some cost segregation on. And we constantly put these deals together. They got to make sense on the numbers, right? Because the prices are very high, so you got to be careful. But one of them right now, it's 135 units in Phoenix, Arizona, that I'm working with a gentleman, and we're raising some capital, and he's the GP on. And there's a thing called cost segregation or bonus depreciation, where you can put a portion of that investment funds of, let's say you put 250,000, maybe 300,000. I'm just giving a rough number into this deal as a passive LP investor. Then at that point, the cost seg and its bonus depreciation this year is a last year for 100%. Next year, it's going to go to 80. Then it's likely that we could block out that 22,000. Okay. You got to check with your CPA, look at everything. But that's a simple way where you don't have to do the deferred sales trust. You can be an investor. You have to, obviously, get to know the sponsor, get to know us, get to know the deal. But that's another way that you can do it besides the oil and gas if you're more comfortable with investment real estate.
Yeah. Right. Okay. I'll talk to you further about that.
Cool. Great job, Dennis. Thank you for participating. I hopefully you got some value. I think you did. Anybody else have questions on what just happened, what we just said, or any other questions? We have Leah raising her hand. Leah, how you doing?
I always have to say something when I come on here. It's the Leo in me. Sorry.
Love it.
Just wanted to appreciate again, Mark. Thanks so much for spotlight shine on you, and you just came out of the ballpark just with all kinds of knowledge, and I appreciate you doing that. And then secondly, Brett, again, Jake, I love that you guys did the whole math problem, the formula live for all of us to just kind of understand the breakdown in Brett Swarts' brain, and to see you just do the whole formula was really awesome. Thank you. I appreciate that.
So welcome, Leah. By the way, it's a good time to talk about a co-educational event that's coming up on June 30th. Leah, you want to drop what's going on?
So there's going to be an amazing event that Brett and I and a couple of other agents, Joseph's here too as well. We're going to be putting that together in Berkeley, California. We are going to be discussing it's called Art Tech Flow. And basically, we're going to hopefully bring in the community artists, investors, technology, and real estate, and just talk about, all of the incentives that we can do in terms of understanding tax deferment as a vehicle, or if there's other, things that we can discuss, other people that we can meet, network with, just to bring capital gains tax solutions out there and just let everybody know the different vehicles that we can use.
Yeah, live and in person. So if you're anywhere in the Bay Area, anywhere, if you want to come in on California, everyone's welcome. And it's live and in person. And we're going to do kind of an expert panel. Our goal is to bring in a top expert in the crypto space, a top expert in the real estate space, a top expert. I'll be the top expert in the tax deferral space, right? And we might even bring a CPA who's skeptical, right? Just to give a little flavor to the whole conversation.
Provide dialogue, right? Yeah.
Yeah, exactly. And so and it's cool. It's going to be in person. It's an amazing venue. And a great opportunity for anyone. And that's June 30th. If you want to learn more, you can go to capitalgainstaxsolutions.com, shoot a message, and we'll be promoting that more and more. And so we're running close to out of time. So just seeing if anyone else has any questions or thoughts before we let everybody go. It's been a good almost hour here on the Deferred Sales Trust, on the process. We do have one in the chat here if nobody has any questions. But if you do, you can unmute or just speak up. Awesome. I'll go to the fee here. So John asks, how much are the fees on the 109,000? Are those fees deductible? Okay, John, good question. What are the fees? I think is a better question on the Deferred Sales Trust. So the fees are about 1.5% on the gross sales price. So to keep it simple, let's imagine it was $1 million primary home or cryptocurrency or business sale. It's about $15,000. That's a one-time fee to the tax attorney that covers lifetime audit defense. And then Jake and I, we're about no more than 2% on a recurring basis, depending on the actual net proceeds into the account and depending on how and where the funds are invested. And so our goal is to net 8% compounding net of those 2% over any 10-year average. So that's kind of the goal. And so that's kind of why we have this $1 million, right? Because we want it to be 250, 350, 400,000 of tax liability that's deferred. So we, instead of having, let's say 600,000, we have $1 million. And that's how we're able to make sense of the ROI. what are the ROIs on the deferred sales trust? Well, of course, the first one is the capital gains tax deferral and being able to be, say, 40% head start on that marathon and maybe not 40% behind on that marathon. But the second one is income tax deferral, especially for people who are in California. Since we're in such a high income tax state, call it Taxifornia. I grew up here. I love California for a lot of things. Taxes is not one of them. And so what you can do with the deferred sales trust is you can delay the payments, sort of like an IRA or 401k, and that the full amount of the investment can be growing. Now, your note is still accruing at 8%, because remember, this is a promissory note situation. But you only pay in what you receive. And as you receive it, you'll pay tax. And so that's a nice little piece. We just did a deal in Colorado for a client who lived in California. And for them, they had a $25 million net worth, and they had a $5 million sale in Colorado. Not only did they defer the capital gains tax, but they also moved the $5 million outside their taxable estate, which eliminated the 40% death tax for their estate, but they also deferred the income tax in that they delayed the payment for a couple years. So these are all the little ROIs that we'll walk you through. Any one of them can make sense of the deferred sales trust, but when you can stack 1, 2, and 3, the fourth one being optimal timing, buying when the deals make sense, that's when these thing becomes transformational for our clients. So hopefully that answers the question. It's not really, John, on the 109. It's really on the entire assets under management and the gross sales price. But John, you're welcome to unmute yourself and ask if you any clarifying questions there. Happy to answer those.
Oh, he said great answer on the feed.
Oh, there he is. Excellent. So Jake, if people want to get in touch with you, well, actually, let me start with Mark. Mark, people want to get in touch with you because you're new to this, and we're hoping you're coming back too and being a regular attendee and or contributor. By the way, Mark is one of the co-founders, one of the original founders of GoBundance, which actually might be even a better way for those who don't know GoBundance. It's one of the top leadership community movements and maybe the history of leadership in the last 10 years. It's incredible. I have really good friends there. I was this close to joining. COVID hit, all these excuses. But Mark, you're the co-founder of that, which is maybe another topic to talk about on another time. But if people want to get in touch with you, what's the best place for them to find you, Mark?
Well, I have a program called the Cash Flow Machine, and it's cashflowmachine.io. That's if you want to find out about that program specifically. If you want to find out other stuff, it's markyegge.com, YEGGE, or you can go to my company, destinycreation.com. So any of those three. And it was, I guess I better learn a little bit more about what you guys do if you're going to put me in the spotlight. I mean, that was fun. It was a pleasure being here. I got to jump to my own mastermind call. So thanks for having me, and thanks everybody. Great to see all your smiling faces.
Thanks, Mark. Thanks for having me. Thanks for sharing. Jake, for people who want to get in touch with you, what's the best place for them to find you?
strategictaxsolutions.com. There's an appointment booking link there, strategictaxsolutions.com. You can also call our 800 number, 1-800-773-1848. And of course, here every Friday, Brett, this is where we're at.
Thank you so much, Jake. And for those who want to get in touch with me, you can go to capitalgainstaxsolutions.com. Hey, remember that not having a clear plan is the enemy when selling highly appreciated assets. In fact, you need to set up the trust prior to closing. Of course, we do this all at no cost obligation on the consultation and walking you through it. But you want to get with us early if you're even considering selling anything. And it could be in the next year or two. It could be in the next 30 days. Get with us early so we can set everything up, answer your questions. But not having a clear plan is the enemy, and using a deferred sales trust might just be the best way for you to exit highly appreciated assets, defer hundreds of thousands and millions of tax, create and preserve more wealth, help your clients, friends, and families do the same. Take a look at the book. It's coming out. The Jake Muller is going to be in the book, as well as Kevin Harrington from Shark Tank. And it's my new book called Building a Tax-Deferred Exit Strategy, and it's the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or your clients. This is going to be a big day when it's officially out, but look for that here in the next 30 days or so. And invite someone next week. Appreciate everyone out there. Talk to you soon. Bye now.